Welcome back, everyone, to another episode. I'm your host, the Millennial Investor, and today we're going to go over some interesting portfolio outcomes. I found this website called Portfolio Visualizer, and basically what I wanted to do is I wanted to take three different outcomes. I wanted to take the performance of 10 of my top blue chip stocks. I also wanted to take a different portfolio, one that I currently own. Now, I know my portfolio will change over time, but I wanted to just look at the current allocations that I have right now and compare that to the overall market performance. I also wanted to look as well at just basic portfolio, but with the weighting of bonds, comparing that just to traditional performance of the market. And then after that's all said and done, I'll probably get into some recent news involving my stocks and then just the stock market in general. But overall, guys, if you're not familiar with me, my name is Jordan. I'm the Millennial Investor. I track my annual dividend incomes through these four charts, through my annual dividend income, my monthly dividend income, my portfolio value, and my monthly YouTube income. And on the left, these two left columns right here, these are the 27 stocks that I own and what they pay me on an annual basis down to the penny. I've weighted it down to the penny based off the amount of shares that I own and what they'll pay me every single quarter and then multiply that times 4. Now, if you want to see my YouTube income, this is broken down by category on the right there. This is updated every single month along with these charts. But if you're new to the channel and you want to follow along with me, I would invite you to subscribe. And if you want to support me and my channel, one of the ways that you can do this is that you can go to the description and check out this referral link. You get $10 just for getting signed up with M1 Finance and depositing $100. And speaking of signing up through the referral link in the description, there's lots of other things in the description as well, including this link to my portfolio through all 27 stocks, as well as other things like credit card referrals, mentoring calls, Yada savings accounts, all different types of things like that. So if you're interested in anything like that, go ahead and check that out below. But if you want to see the 27 stocks that I currently own, I will scroll through them right here and you can pause the video if you want to see the 27 stocks. And there you go. There's the 27 stocks that I currently own. But let's go ahead and look at these three different outcomes. And when we look at SPY, SPY is the S&P 500 ETF. This is just average market returns. This is the largest ETF on earth because traditionally a lot of people like to just buy and sell the S&P 500. A lot of people like to retire off of this investment, and I wanted to show the key differences between my portfolio based off of a traditional investment like the S&P 500. Now, the S&P 500 currently has a 1.7% dividend yield. But if you compare this to my portfolio, let's go ahead and go back here and let's click share this pie and then open up my referral link. Okay, so I have it pulled up here. If we pull up my 27 holdings and pull up my dividend yield, it's currently about 3.4%. But if we go back here and go back to the average S&P 500, its current dividend yield is only 1.7. So my dividend yield is currently about double that of the S&P 500's. Now, the reasons why I always talk about why I love dividend investing and reinvesting my dividends and changing my portfolio weights, I think in the long run will outperform the stock market. Now, right now I'm 100% equities, no bonds in the portfolios because interest rates are at 0%. But when we go to this, let's go ahead and just pick 10 blue chip stocks from my portfolio. Now, once again, I did not cherry pick any of these numbers. I didn't pick some specific stocks that have done really well. Some of these have done really good over the last 25 years, and some of them have done very poorly. And this is going back all the way to 1995, so the last 25 years. Now, we're going to be comparing this to the SPY. Now, the 10 stocks that I picked, McDonald's, Coca-Cola, Pepsi, Johnson & Johnson, Kimberly-Clark, Procter & Gamble, JP Morgan Chase, 3M, Home Depot, and Realty Income. Now, if you noticed, all 10 of those stocks are stocks that are in my portfolio. A lot of them are a very large weighting in my portfolio, make up a huge chunk, and those 10 stocks alone, if I had to guess, probably make up about like 30-40% of my portfolio. Realty Income by itself makes up 7%, PepsiCo 5%, you get the point. But if we go to this portfolio and we click Analyze Portfolios and we look at the returns over the long run and we just put these at an equal 10% rating. Once again, did not cherry pick these stocks, just pick these different stocks. Now, if you look at this over a logarithmic scale, you can see that the portfolio actually outperforms that of the S&P 500. Now, what's really interesting is that if you look in times of recessions, if you look in the dot-com bubble and you compare this portfolio with all these blue chip stocks compared to the basic market return, just compared to the S&P 500. Now, if you look here, go to 2000, 2001. This red line is the S&P 500, and notice how hard the market came down in 2000, 2001. This went from about $36,000 all the way down to a low of about $20,000. So about cut in half there, a pretty significant downturn. But meanwhile, if you look at my portfolio, it actually went up. It uptrended throughout this recession, and it had a slow downturn from 37,000 to 29. Let's go further. Let's go to the Great Recession in 2008 during the financial crisis. From 2007 to 2009, the portfolio went dramatically down for the S&P 500. It went from about $41,000 all the way down to $20,000. So literally got cut in half in the matter of 2 years. But meanwhile, if we look at my portfolio, at the all-time high in 2007, it was right about 60 grand, and then it only went down to about 41,000. So the downturn in the portfolio with these 10 blue chip stocks were a much smaller downturn than that of just the basic market return. Now, what's the best part of all this is if we turn off logarithmic scale and we go to just a traditional scale and we look at the market performance of my 10 blue chip stocks compared to the S&P 500. Look at the difference here. Not only the downturns are much more protected, but the upside potential is much higher than that at S&P 500. Oh, by the way, something I forgot to mention, if we scroll down here, the dividends are reinvested for both these portfolios. I probably should have mentioned that. But if we go to the CAGR, the CAGR, the compounded average growth rate, basically the S&P 500 since 1995 has produced a 10.05% overall return on an annual basis. But the portfolio that I drew up with these 10 blue chip stock has performed 13.16%, making a $117,000 outcome out of a $10,000 investment in 1995 compared to almost $250,000 with that of the 10 blue chip stocks that I picked, not even cherry picking, just giving an average 10% weighting to each of them. Now, if you go to the best year actually outperformed that of the S&P 500 at 47% compared to 38% with the S&P. Now, the worst year is what's really important here. In the blue chip stock portfolio, you had a minus 15.87% downturn versus the S&P 500's negative 36.81%. That is a huge difference. And the max drawdown here, when we talked about from 2009 when the market downturned during the financial crisis, the portfolio for the blue chip stocks went down almost exactly 30%. 30% is a big downturn, but it's not nearly as much compared to the S&P 500's over 50%. If you had $100,000 invested in the 2007 range all the way to 2009, you would have lost over half of your portfolio in the matter of 2 years. But if you would have been investing in blue chip stocks, you would have only lost about 30%. Now let's go ahead and look at annual returns here, and let's look at on a year basis whether or not portfolio 1, the blue chip dividend stocks, whether dividend investing outperformed that of the S&P 500. In 1995, the blue chip stock portfolio won. 1996, blue chips won. 1997, S&P won. 98, S&P won. 99, S&P won. In 2000, blue chips beat significantly. 2001, blue chips beat. 2002, blue chips beat. 2003, blue chips beat. 2004, blue chip. 2005, S&P. 2006, blue chip. 2007, blue chip. 2008, blue chip. 2009 S&P, 2010 S&P, 2011 blue chip, 2012 blue chip, 2013 S&P, 2014 blue chip, 2015 blue chip, 16 S&P, 17 S&P, 18 blue chip, 19 S&P, and then so far in 2020, the S&P is out returning just a little bit of that of the portfolio 1 blue chip. Now, if we go ahead and add these up here, let's go ahead and add these up. So, of the last 25 years, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, and 17. So of the last 25 years, 17 of those 25 investing years, portfolio 1 with the blue chip dividend stocks beat that of the average return of the S&P 500 if you're just investing in the basic stock market. Now what's really interesting here is the downturns. We look at these 3 years here, like for example 2000, 2001, 2002. Now if you look to 2001, the S&P 500 went down almost 10%, but portfolio 1 actually produced a positive return. If we look for 2001, the portfolio 1 with the blue chip stocks went down almost nothing. It went down 1.7%, but meanwhile the S&P went down 11.75. And then once again through 2002, it shielded you from almost double-digit pains of only going down 12% versus the S&P's 21.59. And then you see during 2008 a massive difference there. But now let's go ahead and look at my portfolio, the current weightings that I have, and let's go ahead and compare this to the 27 stocks that I own compared to the S&P. And let's go ahead and click Annualize Portfolio, and let's scroll down here and let's go to the performance. Now it only goes back to 2015. I'm sorry, because some of these stocks weren't public that long ago, because of some of them, like Next Energy Partners and Store Capital, haven't been public very long, so I can only take this back to 2015. But first, let's look at the logarithmic scale. Now, first of all, my portfolio is designed to be defensive. It is supposed to underperform the S&P during bull markets, but overperform in bear markets, much like that of the blue chip stocks that we saw here. But the funny thing is, I actually didn't know this. My portfolio was actually outperforming that of the S&P 500 over the last 5 years in a bull market, and the downturns have been much less significant. If we go here and take off logarithmic scale, and you can see the downturns are not nearly as bad with my portfolio as it is compared to the S&P 500. Now the CAGR, the CAGR, is much better than that of the S&P 500. The S&P returned 11.03%, while mine performed 12.69% with dividends reinvested. The max drawdown went down a little bit more than that of the S&P during 2020. Now let's go ahead and scroll down here and let's go ahead and look at the year-over-year performance. Every single year, except for the last 2 years, my portfolio has beat the S&P, and by these first 3 years, it was pretty dramatic. 2015, 8.8% versus S&P's 1.2%. 14.9% versus the S&P's 12%. And then 2017, 25.59 versus the S&P's 21.7. A dramatic difference here, and in 2018, it actually was almost break even when the S&P went down 4.5%. So basically, this portfolio has been outperforming that in the long run compared to the traditional S&P. Now let's go ahead and look at just the basic portfolio. What I wanted to do is what I've been doing in my portfolio is I've been investing all in equities. If we go to my portfolio here, all 27 holdings are all in just basic stocks. There are no bonds in the portfolio, no other type of hedges, no types of derivatives or anything like that. But this portfolio is designed to be defensive throughout any market weather. Now, in a normal recession, when interest rates are not at 0%, normally I would have some bonds in my portfolio. How much depends on the market conditions, but usually I would at least have 5, 10, 20, 25% bonds in my portfolio. But I think right now it's not the best time for bonds, so I tend to go all equities until interest rates tend to rise and bonds are at a more attractive valuation. Now what I did is I took the two ticker symbols, SPY, just the S&P 500, and I put 20% in a ticker symbol TLT. Now let me go ahead and look this up just so you can get a good idea what TLT is. It is the iShares 20 plus year Treasury Bond ETF. This currently yields about 1.6%, and it has performed very well over the last 5 years, considering that interest rates are at rock bottom prices. But basically, this only focuses on long-term Treasury bonds that are 20 years and older. And basically what this will do is if you're investing in TLT and SPY is that you'll get protected a little bit better of that of just investing in traditional equities. You're protected a little bit better. So if you put 20% of your portfolio, I didn't look at these numbers until I was actually getting ready to film this video, and I was actually shocked by the results for one reason and one reason only. If you look at the CAGR, the compounded average growth rate, it actually outperformed that of the S&P. I was expecting that this would be slightly lower, but it actually outperforms that of the S&P 500, going all the way back to 2003 when this portfolio was founded, when TLT officially went public. That's as far back as this can go. So going back to 2003, this actually outperforms that of the S&P 500. So if you see here, if we put on logarithmic scale, and you can see the downturns are heightened just a little bit. You see when this goes down, it is protected much better than that of the traditional S&P. Now when it goes up, you see how the red line tends to get a lot closer to the blue line, but when the market inevitably goes down, it starts to drift away from it a little bit. But if you look at this, it is a really similar performance, but during downturns, it is protected a lot more. And this is definitely shown by these two numbers right here. The worst year in Portfolio 1, with bonds in the portfolio, went down 22.66%. But if we look at the worst year for the S&P, it went down 36.81%. Compares that to the max drawdown, the worst time in the portfolio, this portfolio went down 38.06%. But comparing that to the max drawdown with the basic S&P 500, this went down over half the portfolio, just like we saw in 2008 and 2009. This portfolio would go down 50% in a recession, but this one would only go down 38%. And it outperformed that of the S&P. So this portfolio would definitely help manage your emotions through downturns in the market. And you can see just gradually over time, this portfolio really shines in recessions and it doesn't get hit nearly as hard on these downturns in the market. But overall, guys, this just shows you an idea with 3 different portfolio types. And I think this really gives you a good idea and a different perspective on what you can do with your portfolio for not only dividend stocks, but protecting yourself in general for market downturns. As we've seen, this will beat the market and provide less volatility, a lower beta than that investing in the S&P. Investing in my portfolio has done much better than that of the traditional market over the last 5 years, and just investing in just basic blue chip stocks does a massive difference over the long run, going all the way back to 1995. Now, I want to do one thing real quick before I end this video. I want to just show the last 5 years of this portfolio with the blue chip stocks, comparing this to the S&P. If we go to the last 5 years here and we click Analyze Portfolios and we pull up the chart for the S&P in the last 5 years, this actually still beats the portfolio, but okay, it's pretty close. And the further we go out, let's go to a 10-year chart. If you see the 10-year chart and we click Analyze Portfolios, and then we look, you see how there's starting to be a gap here? Okay, well, let's go ahead and look at 15 years out. Let's go to 2005. Okay, let's click Analyze Portfolio. See how it's starting to get a little bit more dramatic? And if we go back all the way as far as we can go, if we go back as far as these stocks went public, as far as it'll let us go all the way back to 1985, you see when this dramatic difference really starts to take place. If you would have invested $10,000 in 1995 in the S&P, you would have performed a $117,000 portfolio. But if you invested $10,000 into Portfolio 1 with 10 basic blue chip stocks that you all know and love every single day, this would have performed a $241,000 return, performing much better and protecting yourself a lot more from downturns, and even beating that in bull markets because your dividend yield is double that of the traditional market. But overall, guys, thank you guys so much for watching. I really appreciate it if you made it all the way to the end. Like I said, if you want to view the 27 stocks that I currently own with the target weightings that I currently have on all 27 stocks, if you use this link that is down in the description, you can see all 27 stocks and see how I'm trying to beat the market every single year, and it seems like I'm doing pretty good. But overall, guys, thank you guys so much for watching all the way to the end. If you want to get signed up with M1 Finance, this link will be in the description. You can get $10 just for signing up and depositing $100 to the platform. Like I said, M1 Finance is absolutely free, no fees whatsoever. In my opinion, it's the best brokerage out there, especially if you're a dividend investor. But thank you guys so much for watching, and I'll see you guys next time.